Cool. Well, welcome everybody. I'm so excited for this webinar today. We're going to talk about preparing your rental business for tax season. We have our awesome experts from Keystone CPA here, Amanda and Matt. Thank you so much for joining us. They're going to get us started with talking about some high-level tax strategy. If you guys want to start sharing your screen. Um, and then Adam
Oh,
is
excuse me.
our accounting director from the TurboTenant side of things, and he's going to talk about applying those strategies and really get into the nitty-gritty. So I'm super excited to hear both of these presentations today. Few housekeeping things before we get started. This webinar is being recorded. We will send out a replay to everyone who registered. So if you have to hop early or if you just want to watch some of these awesome expert insights later, don't worry, we will send that to you. We also will be sending two free downloadables from both of our speakers or all of our speakers here today. So you will be receiving those in your inbox. And we will be doing Q&A at the end. So feel free to submit your Q&A throughout the presentation to that little Q&A box at the bottom of your Zoom bar. We will address that at the end. Make sure you submit it there so we can make sure our speakers see it and we can address as many questions as possible. But without further ado, Matt and Amanda, do you want to kick us off?
Yes, excited to be here. Thank you guys so much for hosting us, Ava and Adam, and just Troubled Tenant family. We are super excited to be here to talk to you guys about tax saving strategies specifically for real estate investors. And a little bit about us. What I tell people is we are CPAs by day and real estate investors by night. So, like most of you, we also invest in rental properties. It's one of our main wealth building vehicles. And our firm, Keystone CPA, in our day job, we specialize in helping real estate investors nationwide on how to use real estate to effectively save on taxes in the long run.
Yeah, we've got clients all over the country. So, and it runs the gamut from people just getting started to being full-time real estate investors and everywhere in between. So we're excited to be here, kind of hopefully share some good nuggets for you guys today.
Yes. And wanted to let you guys know and congratulate you on being here because there's a famous quote by a judge named Justice Learned Hand who said that in America there are two tax systems, one for the informed and one for the uninformed, both of which are legal. And so that means by you being here and being educated for yourself, you now become part of the informed, which simply means that you can hopefully take advantage of the benefits in the tax code as it relates to real estate investors.
And this is important because it's important that you're here because studies have shown time after time that taxes are our biggest expense. So taxfoundation.org, it's kind of a think tank for nerds like us. They do studies over and over every year, and it's shown that average American spends more money in taxes than food, clothing, and housing combined. So those three things that you think are probably your biggest expenses, put them together, and you're spending more on taxes.
Yeah, taxes are everywhere, right? When you work and you make money, you pay federal and state income taxes depending on where you live. Also, before you see your paycheck, they already took out payroll taxes into Social Security, Medicare. When we buy anything at the grocery store, Costco, Target, we also pay sales tax. If you own a primary home or rental real estate, we pay property taxes. If you sell a property, sell stocks, maybe you're looking at capital gains taxes. And then finally, when you pass away, there's a possibility of paying estate taxes before it gets to the next generation. So
They get you coming and going.
not coming though, when you're born, you don't pay any
Maybe,
taxes.
maybe,
So
I don't know. Maybe parents do.
but here's just some information from taxfoundation.org that shows if you make $500,000 a year in income, this is roughly how much you have after paying taxes. So pretty significant. Now, what if you're someone who does not make $500,000 a year? Well, something else that was interesting we found from the Journal of Economics. This is a research from 2025, actually, that said a person with income of about $350,000 annually loses close to $5 million in taxes over their lifetime. How crazy is that? $5 million in taxes That's money that really would be much better spent if we could use that in things
It's like
like real estate, right?
it's like a gut punch, right? Where he's like, you probably realize this, but you hadn't really thought about it like that. And when you see kind of numbers like that, it really hits home.
Yes, and I think it's no secret that the tax law favors real estate, right? We all know of that. In fact, you probably hear a lot of these folks. You've seen them on social media or on podcasts or read their books about how they invest in real estate to build wealth, but pay very little to no taxes. And we're excited to let you guys know that all those things are true. How do we know? Because these are all clients of ours that we worked with over the years on proactive tax planning. So, yes, there are absolutely things that we can do to save on taxes using real estate. It's not just benefits for people like Warren Buffett or Elon Musk. We can use some of the same strategies, but at a level where, fear zeros than what they've had in the past.
I think worth mentioning too is we did have one of the biggest changes in tax changes in recent history with the one big beautiful bill that was passed in July. From the real estate investors' perspective, it provided a lot of clarity for us, brought back some great advantages and benefits. The biggest one was 100% bonus depreciation. So we had bonus depreciation before, but under the one big beautiful bill, if you bought real estate midway through the year, now with the one big beautiful bill, your depreciation benefits can more than double from that same property. So using 100% bonus depreciation is the way that a lot of our clients are being very aggressive and buying more real estate so they can generate more depreciation and hopefully use that depreciation to help offset other income they make on their returns.
Yeah, just to give you some numbers to put into perspective, we had a client that is currently looking to close on a property for about 750. So, if he would have bought the property earlier in the year before the one big beautiful bill, the first year depreciation on a 750 purchase was about 90,000. If you do cost segregation and accelerated depreciation, but now under the one big beautiful bill, it's going to be over 180,000. So, like what Matt said, the benefit in 2025 basically more than doubled, right? Now, the other thing too, just a couple other important things with respect to the one big beautiful bill and real estate investors is that we continue to have qualified business income deduction. And for those of you who are not familiar with the term, it means that up to 20% of our rental income could potentially be tax-free. So this is a huge one. This is, we're talking about it from the context of rental, but that also applies to other real estate income as well, commissions, property management fee, and all those different types. So very significant one for those of you who, if even after write-offs and depreciation, you still have taxable rental income, up to the first 20% could be zero tax. So very significant.
Yeah, it's again, the one big beautiful bill is providing a lot of benefits for real estate investors. But keep in mind that this stuff is not automatic, right? You need to kind of, it's not just going to happen on your return. You kind of need to know how to take advantage of it. Very important to kind of put the right plans in place and the right strategies in place for sure.
Yeah. So let's do a really quick pop quiz. If you guys know the answer, just go ahead and put that into the chat box. And the first person who gets it right, maybe Ava, we can send out a signed copy of one of our tax strategies books. So the question is, what percentage of tax returns we review are not optimized for tax savings? So a little backstory on this. Whenever we work with clients on tax planning, one of the things we do is review a prior year tax return because it tells us a lot about different things that's happened in the past. It allows us to look for opportunities as well as identify exposure areas where maybe somebody shouldn't have taken some deductions. So put in the chat box what you think. What percentage of returns we review are not optimized for tax savings? I'm gonna hop over to the chat real quick to see. I love how people gave answers before they saw the options. All right.
Let's see if anybody's paying attention to the slides.
The correct answer is 40%. If Ava, you want to message the person who was the first to get that right.
Good luck scrolling through that, Ava.
So that's right. About 40% of tax returns we review are not optimized for tax savings. And since we are heading towards the end of the year, we wanted to take this opportunity to talk to you guys about what are some of those common mistakes that we see so that you can make sure you don't fall victim to some of those things.
Victim.
Yeah.
I like that word.
I don't know what else to say. So you don't make some of the same mistakes?
Yeah, I mean, it's victim makes it sound strong. Let's go with victim.
All right, let's start with depreciation. Like we said, depreciation is super, super powerful way, obviously, for to save on taxes. With the one big beautiful bill for properties that you purchase and place in service after January 19th, 2025 is what's eligible for 100%. If you bought and purchased prior to that date, but in 2025, it was at 40%.
And I think that taking a step back, maybe for people who are maybe not even familiar with what depreciation is kind of this gift from the IRS and Congress that allows you to write off a portion of the purchase price of your property every year against the income from that property and or potentially against other income you have under the idea that there's normal wear and tear on the property. So it's unlike a lot of other investments in the tax world. But I think the biggest mistake we see with depreciation when it comes to taxes and tax planning is that people don't optimize it. They just take depreciation kind of by default. So whatever you put it in your tax return, whatever it spits out as the normal way of depreciating property, that's what they do. But the beauty with depreciation is there's ways to speed it up. There's ways to slow it down. There's ways to catch it up if you didn't do it correctly over the past few years. And so don't just necessarily take it by default, right? Figure out, hey, what is the right way to do it? And do I want to take more depreciation now? Or maybe I want to save it for next year because next year I'm going to be able to utilize real estate professional or a short-term rental loophole, whatever the case may be. And I can use that depreciation to offset my other income next year. So you want to be strategic in how you do it for sure.
We're talking about year end. If you're someone who is able to benefit from accelerated depreciation, good for you to know that you don't actually have to do cost segregation before year end. Okay. You can do it anytime before you actually file your tax returns. So if you bought a new property this year, you don't have to hurry up and get the cost seg study done. But what you do want to do is make sure the property is placed in service. For those of you with new properties, putting it into service is what allows you to take depreciation. If we bought a property we're still rehabbing and it's not going to be advertised and available until next year, then the depreciation will actually start in 2026. So that's the urgency in putting it into service.
And remember, as I mentioned, depreciation starts based on your purchase price. So the tax code rewards using leverage for purchasing rental properties. You buy a $500,000 property all cash, maybe you get $100,000 of depreciation. Put $500,000 down and buy a $2 million property, you could get $400,000 or $500,000 of depreciation, right? So it definitely rewards using leverage in the right situations.
Yeah. It doesn't have to be a $2 million property. It could be,
a $4 million property.
Several. No, I mean, it could be several properties equaling $2 million in purchase price. The other thing that we see with respect to common mistakes is operating in the wrong legal entities. This is a very significant one because if you operate in the wrong entity, sometimes it becomes too costly to unwind. So for, I think everybody here, landlords, right? With respect to rental real estate, we generally want the properties to be held in LLCs. So LLCs, trusts, partnerships, those are all going to be fine. We generally don't want any rental real estate to be held inside corporations, whether it's S Corp or C Corp.
Or an LLC taxes an S Corp or C Corp. That's important too.
Yes. And the reason for that is because the LLC gives us the most flexibility if we ever needed to move properties in and out for loan purposes. Sometimes lender wants it in your personal name, and the next time when you refi, they want an entity. Generally, you can move property in and out pretty easily without tax issues. Whereas if you were in a corporation, then there could be phantom taxes or taxes on phantom income simply by you moving things in and out. Also, just the whole concept of depreciation and our ability to benefit from it works really well from an LLC to flow through to you versus in an S corporation or a C corporation. Oftentimes, the tax benefits from leverage and depreciation are trapped, which means personally you might not get to benefit from it. So if you are holding your title in LLCs, that's generally going to be okay. If you happen to be in a corporation for some reason, this is the first time you're hearing about this problem, definitely talk to your accountant as soon as possible to figure out what are some of the ways you can unwind that issue, because the longer you're in the wrong entity, the harder it becomes for you to unwind some of these bad structures.
Another mistake we see just in general is just comes to missed tax deductions overall. Real estate investors are really good at capturing expenses tied to properties like interest, property taxes, insurance. But a lot of times those general overhead costs of running a business, being a real estate investor gets missed a lot. So home office expenses, car, travel expenses, dues and subscriptions, things of that nature that aren't, again, tied to a property. A lot of times investors miss out on these because various reasons. They don't have good financial record keeping, bookkeeping, financial statements. Maybe they don't know what they can deduct. Combination of all of that stuff.
Yeah, I think people are really good about deducting property specific things, but a lot of these overhead things that Matt just talked about, our car, we use it for personal and we use it for real estate, making sure you capture those expenses over time. For those of you who have, kids, who can help out in your rental properties and you're trying to shift income to them where you pay them, take a tax deduction, and then, on their end, they can receive the income and maybe use it to fund like a Roth IRA or something like that. These are the things that are typically overlooked when it comes to ways on minimizing taxes. Now, with respect to year end, obviously, if we're looking at capturing our expenses, now is the best time to get everything set up. Because if you're like me, I hardly remember what I had for breakfast a couple days ago. And so to think that in April, I'm going to try to remember everything that I did for 2025, it might be super difficult. If we're talking about paying your kids, we want to make sure we pay them before the end of the year. All the documentation are done before the end of the year so that we can actually save on taxes. And this is what I love about TurboTenant. I think Adam's going to share more about that in a moment, about how, bookkeeping does not have to be this crazy monster thing that we all hate and dread. There are so many ways that you can automate and systematize how to do it. We get a question all the time like, hey, what should I use for bookkeeping? Should I use QuickBooks? Should I use Excel? Should I use TurboTenant? And the answer really is it depends. With respect to bookkeeping and maximizing your write-offs, you're really looking for a methodology that works for you, right? If you are the one doing it as the real estate investor, what are the apps and software you're already using already? How can you leverage that rather than going out and and starting a whole new system, a whole different way of doing it? So it's more so about what is the easiest and most systematized way for you to do it rather than what makes the most sense for your CPA. Right. So we just wanted to share with you today before we leave with an example of, what happens when you put all of these different strategies together. And so this is a client we're working with currently for 2025, Scott and Darla. He's an educator and she's a physician. And so they are buying short-term rentals. That's kind of their tax strategy because they both work full-time. And so to give you guys an idea, these are some of the numbers we're projecting for 2025 in terms of tax saving. So combined, their total income is about $623,000 in total. They bought 2 short-term rentals earlier in this year.
Yeah, so they bought 2 short-term rentals here in Southern California. Purchase price is around $550,000 each. They were going to spend about $100,000 to furnish the properties. So conservatively, we're kind of expecting them to estimate they're going to make around $30,000 in net rental income after deducting normal, operating expenses from those properties. And we've got them self-managing it to kind of maximize cash flow, do things like that, and able to take advantage of some of the tax code strategies.
Yeah, and just some small numbers to share with you guys, because we talked about paying your kids, like how significant does it have to be? So for them, just some small amount, about $8,000 to I think they have 2 or 3 kids. Just capturing car, travel, business development costs. Again, nothing crazy. Didn't go out and buy a new car or anything like that. But the biggest one you'll see here is depreciation. So accelerated depreciation using 100% bonus depreciation on 2 properties is getting them a very significant tax deduction of almost $290,000. And with all of these together, their total income that would be subject to potential taxes is much lower now, right?
Yeah, so you see they went from almost $650,000 income down to under $350,000 in income. And this is going to save them about $112,000 in taxes this year. So a huge change for 2 people that are working W-2, feeling the pain every April of having to pay taxes, having so much money they're taking out of their paychecks and going to taxes. this is going to be a game changer for them.
Yeah. So, as I said, it doesn't have to be any crazy moves. I mean, if you're a rental investor, make sure you're talking to your tax person before the end of the year to optimize your tax savings, because where your numbers fall on December 31st will determine how much or how little taxes you pay next April, right? So take the time now, because most accountants are not super busy now, but they will be in April of next year. And the thing to ask yourself, though, too, is does your accountant talk to you more about what you cannot do versus what you can do? That's a complaint we hear a lot from people that we meet. And so, if that's how your relationship is with your current CPA, we have a toolkit that you can utilize to see if you're part of the 40% who might be overpaying in taxes. If some of the stuff that we talked about today is new to you, real estate professional, cost segregation, you can scan the QR code and access our free toolkit from our website to make sure you empower yourself and get educated on all the different things that you can do to save on taxes and take advantage of the tax code as a real estate investor. So with that, I'm going to give it back to Ava and Adam.
Let's go.
Awesome. Thank you guys so much. That was really awesome information. And we already have some awesome questions coming in the chat. Just another reminder, make sure you're submitting those in the Q&A box so we can address them when we get to Q&A at the end. And I will make sure to send out that tax savings toolkit via email and a way to connect with Amanda and Matt at Keystone. But yeah, now we're going to kick it off to Adam, who is going to talk a little bit more about applying these strategies. But yeah, thank you guys so much. That was great.
Okay, so I've got a little bit of a different perspective to bring to y'all today. But first of all, my name is Adam Hamilton. I'm the co-founder of REI Hub. We were an accounting software built specifically for rental properties and real estate investors. Now part of the TurboTenant team, where I lead our accounting division. So I've been a rental property bookkeeping expert for the last 6 or 7 years, but it's been not from the same perspective as Amanda and Matt, but from kind of the ground level perspective that a lot of our day-to-day investors find themselves in, of saying, what's the best way to go from a set of bank transactions to financial records that can allow us to access and activate some of the strategies that we've just heard about. So if you ask me, good bookkeeping is for more than big businesses and for accountants, right? It's something that should be accessible to all of us because it's something that allows us to really learn more about our business and find different ways to leverage our own skill sets to help us pay less and save more. So Amanda and Matt have given us a lot of different ways that your CPA can help you do more with less, that they can help you take on and find opportunities to save a bunch of money. But what is your opportunity besides hiring Amanda and Matt, right? How can you lower your tax liability? How can you keep your tax prep costs down? How can you make sure that your tax returns are as accurate as they possibly could be? Well, the answer is with good bookkeeping, right? That's how you can understand if your business is actually performing. That's how you can know the score and make sure that you're not going to have to send off all of your numbers to your CPA and then have them turn around and send them right back to you and say, hey, this wasn't done right. And you can either pay me to fix it or you have to fix it right now, right? So our goal today is to talk about some common ways that we can think about our bookkeeping to make sure that we're putting things into the right places up front. That helps us understand our business better, that helps us know the score and make sure that we're on our way to becoming a profitable investor, and making sure that we are not going to be relying on our CPAs to help us with the day-to-day stuff so that they can keep their minds and their efforts focused on the big changes and the unique and the advanced strategies that are going to enable them to save you the big bucks. So just to set the stage a little bit, we're going to look at just briefly why rental property taxes are so unique, some of the key factors that impact tax treatment of money in the door and money out the door, take a very quick look at some easily missed deductions, and then finish up with just how software can help us make sure that we are hitting on all of our goals here. So first off, why are we having to talk about this, right? Like, isn't taxes and accounting like solved, right? Don't we all have access to the internet and AI and endless amounts of resources. Well, the reality is that rental property is not your average small business, right? It's not the same thing as running a service business. It's not the same thing as running a retail business. It's not the same thing as running your average Main Street or what we often think about as small business in America. For the majority of us, it's a passive activity. That means that it is income derived from something that we own rather than something that we do actively. And that's something that changes the tax treatment. And don't get me wrong, there are different ways that we can handle this, also from advanced strategies, things like the short-term rental loophole to allow us to recategorize passive into active income that can then allow us to write off against our W-2 or other earned income. But for the majority of us, we've got to keep in mind that this is passive income, which means that it goes onto its own tax form, right? We use a different tax form for real estate than we do for a generic small business. And that also means that we've got to pay attention to some different things. We also find that rental property taxes are almost universally filed in cash basis. At the end there, Amanda said, hey, your opportunity to change something for 2025 taxes is now between the end of the year, because for all of the 95+% of us real estate investors who file our taxes in cash basis means that we're recognizing transactions when they're occurring, which means that next March, you can't buy something and then say, oh, well, that was for last year, right? So that's why we've got to pay attention and know that what we're doing now is what is impacting our 2025 and our calendar year taxes. Additionally, rental property is unique because we have a requirement from the IRS's perspective to track our numbers on a per property basis. And this doesn't sound so surprising, but then you think about, the corner store down down the road, and imagine how much more difficult their bookkeeping would be if they had to report revenue and expenses on chips versus soda, right? That seems like that would be a little onerous, right? Well, we have that requirement because we've got different properties that are different investments, and almost all of our tax forms are going to require us to enumerate those out and make sure that we are tracking those things with fidelity on a property by property basis. And then the final thing that makes rental property taxes unique is that even if we've got a CPA, the majority of us are keeping our books by themselves. And I really can't think of any other industry that has non-financial professionals keeping the books for businesses with assets in the millions of dollars, right? Think about that. You don't have a profitable restaurant group with 6 restaurants and $3 million in annual income with one of the servers keeping the books, right? They've got a financial professional for that. But here, in the uniqueness of real estate, we often find ourselves doing it ourselves, which means that we need to avail ourselves and take advantage of resources and higher degrees of knowledge from people like Amanda and Matt and other CPAs, as well as to use organizational systems like software and frameworks that are built specifically for rental property, which allows us to save time and kind of have less headaches as we go through it. So coming through, we're going to start taking a look at some key factors that impact the tax treatment of the different funds that we are receiving and spending on our rental properties throughout the year. Not as much to say here on the money inside, but there are a couple of key things to remember. Number one, we need to categorize everything that we receive from a tenant, with a few minor exceptions, as rents. We can have different sub-accounts, we can track them in different revenue accounts, but at the end of the day, on the IRS Schedule E, or the Form 8825, which the vast majority of us are going to file our rental property income and expenses on, there's only one line for your revenue, and it says rents received, right? And so all of these things, all of your rents, including your base rent, your parking rent, your pet rent, and anything else, anything received from a tenant, like an application or a parking fee or a late fee, any utilities that you collect directly from your tenants, any security deposits that you keep, or any cleaning fees you charge your tenants if you're in a short-term rental, all of these things are revenue and will be reported to the IRS as rent. And I say all because it's important that you additionally recognize that this is your gross revenues, your gross rents, not your net. The IRS wants to see the totals, everything that you earn minus everything that you spend. They don't just want to see the net, right? And this is especially relevant for those of us who receive rent through a property manager or through a platform, because oftentimes we will have $1,000 deposited into our bank account, but maybe that was actually $1,100 worth of rent and $100 of management fees to that property manager. And we are on the hook for showing the government both of those things. And the more that our reporting matches up with the different reports that those platforms and property managers are also going to send into the IRS, the better and the lower our opportunity or our likelihood of an audit is going to be. Now, there are a couple of notable exceptions in terms of funds received from a tenant or a guest that should not be categorized along with your rents and your revenues. Primarily, your security deposits or any refundable deposit. If there's the chance of returning it back to the tenant, then it doesn't need to be counted as rent. Our earned interest is still relevant, but the cents that you earn in your rental property business checking account is not going to be reported on the IRS Schedule E or 8825. It'll probably go on the Schedule A. So while it's important to still know and have available, it's not something that is going to go directly onto your rental property forms. And then finally, for the short-term rental operators in the crowd, if you are passed through any occupancy or hotelier taxes where you directly or the short-term rental platform are not remitting those directly to the government, those should be held separate from your rents and your revenues, as those are taxes charged on the tenants that get passed through to the municipality or the government and therefore are not revenues for you. Rent's relatively simple, but once we get into the money that we spend on our rental property, all of our costs, we've got to look in a little bit more granular detail. And there are kind of four big buckets that most of the transactions that are in your bank account as you're preparing for your rental property taxes, most of the costs in your bank account are going to fall into one of these four buckets. So deductible expenses, capital expenditures, loan payments, and then non-deductible withdrawals. And I'll go through each of these in a little bit more detail. So first and foremost, deductible expenses are our operational costs. They're the ordinary and necessary expenses of running a business and the costs to manage and or maintain your rental property and keep it in operation. So when we say the word expense, this is what most people think of. When an accountant says the word expense, this is explicitly what they're thinking of rather than some of the other costs. And these are the items that are going to be organized into your Schedule E or your Form 8825 with the default categories provided by Congress that don't always match up exactly to our modern day rental property expenses, but that we should put in there selecting the category of best fit. For example, in 2025, we use a lot of software to help us manage and run our rental property businesses, but there's not a category for software on the IRS Schedule E or on 8825. So we'll just need to choose the one that is the closest, right? So I personally will often choose legal and professional fees as the closest one for software expenses, unless it's something explicitly related to like advertising or management, in which case I might choose those expense categories. And then there's the capital expenditures, your CapEx or your fixed assets. These are the acquisitions and improvements that you must depreciate over time. We talked a lot about this with Amanda and Matt, but just to get explicit with it for anybody newer in the audience, these are the investments in your business that are either creating the rental business or improving it in a substantial fashion. So primarily, this is the property itself. As Matt was saying, you get to deduct a portion of the purchase price of that property. So the property is your primary asset, but so too are separate and discrete improvement projects. So if you have an operating rental that you've had in service for 3 or 4 years, you're depreciating the property on a steady state basis. But then this year, you find you've got to put a new roof on the property. Well, a new roof is unfortunately not something we can just expense. That is a whole home system that is improving the value and the long-term use of the property. And so the IRS says we need to capitalize and depreciate that. But that cost of that new roof doesn't just get shoved in there with the cost of the property. It's its own new fixed asset, its own new capital expenditure project that needs to be held together but separate from the property and be depreciated on its own timeline, because different improvement projects have different timelines. If you do flooring, that's 15 years. If you do an appliance, it might be 5. And then it is the sum of the depreciation entries of the property and each individual improvement project that collectively will sum to the total depreciation for the property that you will enter in onto your tax form, or your accountant will do so on your behalf. So these are hugely relevant to the ongoing bookkeeping for your rental property. And they're one of the things that you are most likely to get pushback from your CPA on if you send them over a profit and loss statement that says repairs, $30,000, right? They're going to say, wait a minute, let's look at these transactions. And they find out, oh, $15,000 for a new roof here, $10,000 for a bathroom remodel there. Are those actually repair projects? Well, probably not, right? And if you can get it right from the beginning, that's saving you time, saving your CPA time, and saving you tax preparation fees in the long run. Just a quick little aside here, I do want to call out our safety net, and that's the de minimis election. So as much as we are required to take care of these capital expenditures by capitalizing, depreciating them, the IRS thankfully also recognizes that it's not always very time effective to do this for every single thing that we would typically consider an asset. The example I always give is a refrigerator. A refrigerator is an appliance, technically an asset that you can depreciate on a 5-year timeline, but they're also not always that expensive. And the IRS has given us a de minimis election of $2,500, which means that if you have an operating property in service and you have a purchase that would typically be considered an asset, but it's under $2,500, you can go ahead and simply expense that because it's not worth your time or the IRS's time to depreciate a $600 refrigerator over 5 years. So for your lower price items, that's a good thing to keep in mind. Now, your loan payments are one of rental property investors' biggest costs, right? And one of the things that is like always included in our math. Does this property pencil? Does this property cash flow? But just because you think of them as one loan payment, our accounting treatment is not that simple. A loan payment is actually 3 transactions dressed up in a trench coat. And the first of which is principal repayment, where you are paying down the balance of the loan that you have taken out. Now, this is simply just returning money that you've borrowed. And the IRS says this is not a deductible cost. So your principal repayment is relevant. It impacts your cash flow. It impacts your profitability, but it's not going to be reflected on your tax forms. And that's a very important thing to keep in mind. Now, your interest, of course, is fully deductible and will be reflected on your tax forms. But then if you have an escrowed mortgage, things get even a little bit more complicated because the escrow contribution from each individual mortgage statement is itself not a deductible expense because it is your mortgage servicer's best estimate of 1/12 of what that year's tax and insurance expenses might be. AKA, it's not the actual expense. And the IRS only allows us to deduct the actual expenses. So your escrow contributions are not deductible, but the tax and insurance costs paid out of escrow are immediately deductible at the time that they occur. Now, what's complicated here is that those tax and insurance costs coming out of your escrow account are not reflected in your business bank account, in your operating financials, right? Because that's happening in your mortgage account. That's not happening in your business bank account. So that's something that you've got to keep an eye on, and it's something that can be easy to miss, which is one reason we want to highlight it here. Now for the final piece on our money spent, we also have to keep in mind that there are going to be a number of transactions in our business bank accounts that are themselves not directly deductible or capitalizable. So which means that if we get these wrong, then we really introduce some uncertainty and some inaccuracy into our books, which can again cause your CPA to say, hey, you need to redo this or you need to pay me. So these are important things to keep in mind as we try and keep our tax prep bills down. First and foremost, credit card payments. Now, you say, oh, well, I use credit cards for my rental business. Isn't that deductible? Yes, 100%. It is the individual transactions on the credit card that are deductible. When you spend the money at Lowe's, when you go to the store to buy something for your rental, that individual $75 to Lowe's, that's your deductible transaction. When you pay your credit card bill, that's just moving money from one of your accounts to another. And if you categorize that as an expense, you're going to be double dipping and you're going to be doing it incorrectly and then causing your CPA to come back to you and say, hey, you need to take out these credit card payments. Similarly, a lot of investors have multiple different bank accounts and they move money between them on a regular basis. And when you've got a lot of $1,000 withdrawals into one account and $1,000 deposits into another, it can be easy to forget and to lose track of which ones came from your internal accounts or which ones came from external sources. But if it's an internal transfer, again, just like credit card payments, that's money moving between two things that you control, and therefore is simply not a relevant transaction for tax time. Finally, your refunded security deposits. So if you've got money moving out of your bank account because you refunded a security deposit to a tenant, that is not deductible. That was their money that you've been holding. You are returning it to them, and it should not be counted as an expense. Now, of course, if that is a transaction that you retained a security deposit, you kept their security deposit because of damage or back rent, then that should be categorized as revenue. And then finally, we all make a mistake once in a while. We grab the wrong card from our wallet, right? Maybe we don't have the funds, maybe we just don't have that card handy, and we will spend on personal items from our business accounts from time to time. These just need to be ignored or categorized as owner distributions, because if it didn't apply to your rental property, it shouldn't go into your rental property taxes. Hope I'm not speaking too loud for everybody or too quickly for everybody, but just trying to make it all through. So we've got time for our Q&A here in a moment. This is just a quick little summary that we'll find that helps us look at the different ways that we spend money on our rentals, and understanding better which ones are deductible, which ones need to be capitalized and depreciated, and which ones are non-deductible. And of course, this will be in one of the downloadables that Ava will send out to everybody post-call. Now, Matt and Amanda highlighted a few easily missed deductions. I've got a few more for you here. Number one is just the simple fact of making sure you entered in all of your rental property transactions. And while that sounds really easy, sometimes it's not, right? And especially if you don't have a rental specific bank account, it can be really difficult. Because if you've got all of your rental property transactions interspersed with your personal transactions, it can get really hard to remember 6 months later which of those Amazon purchases were, for your latest doohickey, or which were for replacing something at the rental property, right? So this is an area where the more fidelity you have with having separation in your rental and personal expenses, the more advantageous and the less likely you are to miss a deduction, because the simplest way to pay more in tax than you should is to not claim all of your allowable deductions. Next, of course, is the question of depreciation. We've already highlighted this extensively. I won't spend too much time on it. The important thing to know, though, is that because this is a little more complicated, because this is an area where we have high-powered professionals who can help us take advantage of advanced strategies, this is an area that is sometimes more often outsourced to our CPAs and our accountants than is managed internally by individual real estate investors. And that's totally fine. But as an individual investor, it is still your responsibility to make sure that you are getting depreciation entered and that you know who was responsible for it, right? So it doesn't have to be you, but you have to know that if you're not the one doing it, you know for a fact that your CPA is, because it is simply too important of a deduction to miss. Miles driven for your rental or different or your auto expenses captured. There's a couple different ways in which you can capture your expenses for your rental property mileage. You can either do it as a proration of personal total costs, personal versus business, or you can claim the IRS mileage rate. But in either case, if you're managing the properties yourself, you almost certainly did some driving, so we want to make sure you get credit for that. And then, as I just mentioned a moment ago with the loan payments, making sure that we have and are able to capture your rental property insurance and taxes, which are some of the chunkiest deductions you're going to have, is an incredibly important one to make sure you're not missing. So whenever you're looking at your Schedule E or your end of year P&L, make sure you see entries under tax and insurance. Very important. Now, of course, how can we make this as easy as possible for us is we can let the software do as much of it as possible, right? By working within a system that has a lot of these rules and a lot of these workflows baked into them, provides an organizational structure that helps us get it right, even without having to have that CPA level of knowledge. So a good rental property accounting software is going to have property by property tracking. It's going to have real estate specific transaction types that allow you to get the complicated accounting right, even without knowing everything up front. You're going to want something that has good tracking for fixed assets, for depreciation, something that can split your loan payments into their principal, interest, and escrow components, something that defaults you into the expense categories you're going to use. And then, of course, ideally, a software and a support team that is able to answer questions, right? Because we're all going to have questions. So that's what I have for you today. Thank you so much for letting me blitz through all that. Again, with an eye and an ear towards how can we individually as investors make sure that we are helping our tax preparers, right? They get one day a year, April 15th. to make you or save you a whole bunch of money. But they are only as good as the work you put in the other 364 days a year to make sure that they have the right information and the right ammunition to save you those funds. Ava, back to you.
Awesome. Thank you so much, Adam. That was so great. Just as a reminder, everyone will receive the recording of this webinar plus 2 free downloadables from our speakers, and early access to the TurboTenant Black Friday accounting sale, which is 4 months free of rental property accounting software. So keep an eye on your email. All those items will be delivered to you at the email that you used to register for this webinar. I am going to jump into our Q&A. We have about 10 minutes just to respect everyone's time. I saw Amanda and Matt, y'all went through and answered a lot of questions, which were so awesome. I do kind of want to go through those because I know that's a lot of common questions that investors have. Do y'all want to take it over or do you want me to jump in? Feel free.
Sure. Yeah,
Yeah.
and you guys can also just look on the answered question tab for the ones that we already typed out. But yeah, one of the questions was, should we set up an LLC for our properties? And the answer is yes, for asset protection purposes. So make sure you check with your attorney on that. For landlords, there's no difference whether you have an LLC or not holding title to your properties. All of the deductions we talked about, all the deductions Adam talked about, are exactly the same. It is a little bit different on the bookkeeping side. If you have an LLC that files tax returns as a partnership, that's where, like the balance sheet and all that will be super valuable for you, because that is reported. But if you're holding it in a single member LLC, meaning you're the sole owner or husband and wife in a community property state where you're where you guys just own it jointly with no like outside partners, then usually that's much simpler from a tax and reporting perspective as well. So definitely recommended, but it's not really for tax purposes. Generally, it's for asset protection purposes.
That's such a great point, Amanda, and something that we get a lot of questions about. And I've got to say, hey, like it's not really about the bookkeeping. But the flip side of that too is that it does come with costs, right? There are,
Yeah.
You've got to pay to keep an LLC in service and active. There are filing fees associated with it. So I agree 100% about the asset side, but also don't forget there are some real financial costs as well.
Yeah. Attorneys sometimes kind of would love, of every single property have an LLC associated and a holding company, a management company. And so part of the role is, for as a team of advisors, we work with the attorneys to say, okay, well, that's all great. Here's the cost. And then the investor can decide kind of that comfort level in the middle where it's not super expensive, but also having some asset protection.
Do you want to just call some questions, Ava? Maybe be
Yeah,
easier if
that
you want
sounds great. Yeah, because there's some really awesome ones in here. I really liked, where is this one? There was a
to.
question. This one hasn't been answered yet, actually, but I really like it. It was asking, how does claiming miles work if I drive an electric vehicle?
it's a good question.
So
I think from looking at a business use percentage of the vehicle, you still need to document how many miles you drove. So kind of using your electric vehicle to document it. Because at the end of the day, whether you're taking the mileage deduction or you're doing actual expenses, you still need to know the number of miles you drove for business versus total.
Awesome. Thank you. And then someone asked, what documentation should be used when paying kids to manage a property that they are living in?
So, the paying your kids is just same as paying anybody else, right? You want to make sure that they're doing the work. You want to figure out what is the reasonable compensation. So just because it's my kid doesn't mean I can pay them $1,000 an hour if that job, the task itself, a fair market value would only be, $15 or $20 an hour. So you treat paying your kids the same as anybody else, have a job description, right? What are they going to do? How are they going to get paid? How frequently are they going to get paid? Making sure we actually pay them. So it's not just like I said I pay them, I actually want to pay them. Money transfers from our bank account to their bank account. And then the last piece is the tax documentation. If they're doing recurring work similar to an employee, typically you'll issue them a W-2. If it's kind of one-off consulting type stuff, if they're older, then you can get away with a 1099. So definitely want to make sure you have the documentations in place. The comment about living in a property, I think that involves a more in-depth conversation because it kind of depends on, is it like a student housing where they're managing it, but it's also rented out to a bunch of, other students and friends and things like that. So different things to strategize about from that perspective.
Awesome. Thank you. And then Adam, this one's for you. Can you do a quick highlight of TurboTenant's features that automate tax prep and bookkeeping?
Sure. So there are a couple of explicit things that we have, like a one-click tax export that allows you to download in a zip file all of the relevant reports that you're able to select or unselect. Like, do you have a partnership? Select the balance sheet. Do you not have a partnership? Deselect the balance sheet. And we pair that up with our tax review process that walks us through those 4 easily missed deductions that I mentioned earlier on the call. But a lot of it is also about leading us into the right place earlier, as opposed to having to do a bunch of work at tax time. So mortgages are an example, right? If you're using QuickBooks or some sort of generic accounting software, every time you've got a loan payment, you're going to do one of 2 things. You're going to categorize the entire loan payment as an expense, which is wrong. It will have to be fixed at the end of the year. Or you split it into the principal, interest, and escrow pieces at the time, and you categorize each one appropriately, which takes a lot of time, right? So something like TurboTenant's loan payment template automates that breakdown into the principal, interest, and escrow split, right? Which just then leads us into having a more accurate mortgage interest number at the end of the year without having to do a bunch of work explicitly for tax prep. Similarly, having a fixed asset or a CapEx area that allows us to have multiple fixed assets per property, each with their own unique placed in service date and useful life, is a unique feature in small business accounting softwares because real estate is so much more asset and financing driven than your average small business, right? Which is why we've got capabilities in this area that go beyond something like a QuickBooks, which is typically going to have many fewer loans per entity or have a less of a prevalence of depreciation and things like that. Then the final thing I'd highlight, one of Matt's points earlier was about the overhead costs that we have in our rental business, right? And sometimes those can be a little arduous to deal with. If we've got 10 properties, but we're only able to put property expenses onto the Schedule E, because the Schedule E says, what's the property address, right? Everything on your Schedule E has to be down to a property. So we have a feature that allows you to categorize overhead expenses at your portfolio level, but then automatically on the Schedule E, prorate them down to the each individual property level, right? So you've got $1,000 that you spent on a real estate education course. Well, that's not assignable to one individual property, but with that feature, then you can take it and with one click, split it down across all 10 of those properties and put a $100 deduction on each of them. There's probably more, but that's probably long enough for that one answer.
Great answer, Adam. Thank you. And I will also jump in here and just go a little bit more high level for anyone who has never used any accounting software, whether it's QuickBooks or whatever. There's a lot of benefit you get out of just using any accounting software because you can attach your credit cards, you can link your bank accounts, and you can set up rules that automates bookkeeping for you within that software. So instead of, having printouts in a folder or having a Google spreadsheet that you're manually managing, it actually automates the expenses and the income that you are making from your rental properties. But awesome. Yeah, thank you, Adam. And then we have time for one more. Is there one, Amanda and Matt, that you really want to answer, or you, Adam, that you think is great?
Let's see here.
It's hard. There's a lot of good ones.
Eric, I see that you asked about deductions when I said that those internal transfers are not allowable deductions. The key learning here is that it is the transaction where the funds leave your control and go to a vendor, or they're spent, or the transactions where it comes from the third party and comes to you. It's those times when the money leaves or enters your rental business. That's when it needs to be categorized as a revenue or an expense or a loan payment or something along those lines. So your expenses are your expenses regardless of how much internal transferring you're doing. So it's totally fine to move money from one account to another and then pay from the final account. The important thing is just to know that in the transaction where you are moving money from one of your accounts to the other account, that one itself is not categorized as an expense. It's the one where it went from the account to the vendor to pay for the service, to do the thing, just to clarify that. And Carla, yes, you can just be a sole proprietorship. You do not need to have an LLC to invest in rental property. I own a rental property in my name. Maybe it's the best thing, maybe it's not, but a little bit of extra insurance. An umbrella policy, for example, is another alternative strategy that allows you to receive protection without necessarily having to go into the additional legal and financial requirements of an LLC. So definitely something you could do.
Yeah, I think there was kind of a related question about how why did we say LLC is preferred even though it's more expensive? You may have to file a tax return. And so just to clarify, when we said preferred, we meant preferred over like a corporation. So if we're saying should I be a corporation, should I be an LLC? For rental real estate, generally it's going to be an LLC because it's more flexible from a tax perspective and it helps you to preserve your tax benefits versus a corporation. Sometimes those tax benefits get trapped. So that's really the significant difference, not to say like you should have an LLC that's preferred over just in your personal name. Again, no tax difference at all, similar to what Adam's talking about. It's really the entity provides you asset protection if that's what you're seeking.
Great. Awesome. Well, thank you so much, Amanda and Matt. That was so great. It's awesome to have experts on the webinar to be able to go over tax strategy because it is very complex and super, super important for all investors, no matter what type of portfolio you have. And of course, thank you, Adam, for diving in with us. I will be sending out this recording and our free downloadables after this webinar. So watch your email. I am, for any questions regarding the webinar, or if you don't receive the recording by Monday, end of day, I'm going to drop our events email in the chat. If you have questions about TurboTenant accounting, you can reach out to support@turbotenant.com. We can send a document with the Q&A answers as well. That's a great idea. And Amanda and Matt, if you want to drop a link or an email where people can reach you guys at, feel free. But yeah, thank you guys all for joining today. This is a really awesome presentation, and I hope you feel prepared for the upcoming tax season because it's never too early to get started.